Okay, so you want to own a car wash. You buy a little piece of land on a busy road, put up a bright sign, install a tunnel full of brushes and soap, and then watch cars roll through all day while your bank account quietly fills up, one wash at a time. It feels like one of the simplest businesses in the world. A dirty car goes in, a clean car comes out. Somewhere in the middle, you collect money. And if you have ever driven past one of those shiny express car washes with 3 pay lanes, colored foam, free vacuums, and a line of cars waiting outside, the business can look almost unfairly good. The customer drives themselves in, the machine does most of the work. There is no kitchen, no shelves of inventory, no complicated menu, no hotel rooms to clean, no tables to turn over. It is just water, soap, pavement, and cars. Sounds simple. It is not simple. Because in February of 2025, one of the largest privately held car wash operators in the country, Zips Car Wash, filed for Chapter 11 bankruptcy protection. The company said it expected to reduce about $279 million of debt. And the strange part was that the washes did not all just disappear. Customers could still drive through, members could still use their plans, foam still sprayed, dryers still blew. The tunnel could keep working, while the balance sheet was broken.
That is the part that makes car washes interesting. From the street, a car wash looks like a machine that turns dirty cars into money. From the inside, it is a local subscription business tied to expensive real estate, fragile machinery, water systems, debt, weather, and customer habits. And if any one of those parts is mispriced, the line of cars outside can fool you. Before you make a single dollar, you have to decide what kind of car wash you are actually buying. There are self-serve bays, where customers pull in, grab a spray wand, and do the work themselves. There are in-bay automatics, often attached to gas stations, where the car sits still while the machine moves around it. There are full-service washes, where employees clean the inside and outside. There are detail shops and mobile washes, which are really labor businesses. But the model that changed the industry is the express exterior tunnel. That is the one with the conveyor belt. The car rolls onto the track. The driver puts it in neutral. The tunnel pulls it through sprayers, foam arches, brushes, rinse jets, wax, tire shine, and dryers. A few minutes later, the customer exits and usually gets access to a row of free vacuums. This is the version that attracted chains, franchise operators, and private equity money because it has the thing investors love most: throughput.
A single self-serve bay can only serve one customer at a time. A tunnel can work like an assembly line. One car is being sprayed, while another is being soaped, while another is being dried, while another is entering the tunnel. The building is not just a building. It is a little factory for clean cars. And factories are expensive. A modern express tunnel can cost several $millions before it ever opens. One public franchise listing for Tommy's Express puts the estimated initial investment at roughly $5 million to $8.5 million, including a $50,000 franchise fee. That is not a universal number. It depends on whether you own or lease the land, how long the tunnel is, what the city requires, whether the road needs improvements, how much stormwater work is needed, and what kind of equipment package you install. But the point is simple. This is not a hose, a bucket, and a dream. Before the first customer arrives, you may have millions tied up in land, concrete, drainage, utilities, permits, engineering, tunnel equipment, payment kiosks, vacuums, signs, chemicals, staffing, and working capital. And even after all that, the most valuable part of the car wash may not be the tunnel. It may be the driveway. You are not just buying land. You are buying a traffic pattern. You need a site where enough people drive past every day, where they can see the sign early enough to make a decision, where turning in feels easy, where cars can stack without blocking traffic, and where the surrounding neighborhood actually cares about keeping cars clean. A car wash on the wrong side of the road can be a different business from the same car wash across the street. That sounds ridiculous until you think about how people use one. Most customers do not plan a car wash like a dentist appointment. They are driving home from work, leaving the grocery store, or noticing that their windshield is filthy. The decision often happens in a few seconds. If entering means crossing 3 lanes, making an awkward left turn, or looping through a parking lot, many people just keep driving. So the first hidden cost is certainty. You spend millions of dollars before you know whether that exact corner will become part of local routine. Then comes the construction problem. A car wash site is a strange piece of property. It needs heavy electrical service for pumps, compressors, dryers, vacuums, and controls. It needs plumbing that can handle large volumes of water. It needs drainage, oil and grit separation, wastewater handling, and often water reclaim systems that filter and reuse part of the wash water. You cannot just spray cars and let everything run into the street. That water can carry soap, oil, brake dust, road salt, and grime. Depending on the location, a commercial wash may need to send wastewater to a sanitary sewer, maintain separators, monitor discharge limits, or install treatment systems. Water is not just an input. It is a utility bill, a sewer bill, a maintenance problem, a permitting issue, and sometimes a political issue. The EPA's WaterSense material notes that conveyor washes in studies averaged about 30 to 34 gallons of fresh water per vehicle when reclaim systems were being used significantly, while manufacturer estimates without reclaimed water can be far higher. It also notes that reclaim systems can reduce freshwater use substantially, but those systems have their own filters, tanks, grit, odor, and maintenance problems. That is the basic trade. You can spend less on water by spending more on equipment, plumbing, and maintenance, or you can spend less up front and risk higher bills or more pushback later. Then there is the tunnel itself. The tunnel is a chain of parts that all have to cooperate in a wet, chemical-heavy environment while cars move through it all day long. Rollers, belts, pumps, motors, sensors, brushes, cloth, nozzles, chemical injectors, blowers, gates, doors, cameras, payment terminals, license plate readers, and vacuum motors. A restaurant oven can break. A hotel elevator can break. But a car wash is almost built out of breakable parts. And the worst time for one of those parts to fail is exactly when the business is supposed to make its money. A sunny Saturday after a storm, the first clear day after a week of rain, or a winter morning when every car in town is covered in road salt. If the conveyor stops then, the business does not become a little less profitable. It becomes a wet garage with a line outside. Now, imagine the site finally opens. A customer pulls up, chooses a wash, pays $10, $15, $25, sometimes more for a premium package, and moves through the tunnel in a few minutes. The cheapest wash might just be soap, rinse, and dry. The more expensive wash might add tire shine, wax, ceramic coating, underbody rinse, extra foam, or a better drying pass. That is the first layer of revenue, the single retail wash. The second layer is the premium upsell. The third layer, and the one that changed everything, is the membership. Instead of charging the customer every time, you charge every month. Unlimited washes. One price, cancel anytime. The camera reads the plate, the gate opens, and the car goes through. For the customer, the pitch is easy. If one premium wash costs $20 and the monthly plan costs $30 or $35, then washing twice in a month feels like winning. For the car wash, the math is even better. The customer pays whether it rains, whether they forget, whether they travel, whether they wash once, or whether the car sits in the garage for half the month. That is the magic word, recurring revenue. To see why investors love this, imagine a single site with 2,000 members paying $30 a month. That is $60,000 of monthly membership revenue before a single retail customer pulls up. Add retail washes, premium upgrades, fleet accounts, gift cards, or interior services, and the revenue picture starts to look very attractive. But now subtract the other side. Every month there is labor, chemicals, card processing, electricity, water, sewer, software, insurance, property tax, maintenance, rent or debt service. If it is a franchise, there may be royalties and advertising fees. If the property is leased, there may be rent escalators. If the site was financed aggressively, the loan payment is not waiting for a sunny weekend. That is why a car wash can have a lot of revenue and still disappoint the owner. The tunnel does not just need customers. It needs enough profitable customers to cover the fixed obligations that were created before opening day. This is where the modern car wash starts to look less like a local service business and more like a software company that happens to spray water. The largest operator in the United States, Mr. Car Wash, shows how central memberships have become. At the end of 2025, Mr. reported 548 locations and about 2.3 million Unlimited Wash Club members. Its Unlimited Wash Club represented 76% of total wash sales for the year. Read that again. For the biggest operator in the country, most wash sales were not from someone randomly pulling up and buying one wash. They came from people already subscribed. That is the real business hiding behind the foam. Mr. also shows why the industry attracted serious money. In 2025, it reported about $1.05 billion in net revenue, an adjusted EBITDA of about $345 million, an adjusted EBITDA margin of 32.8%. In May of 2026, it completed a take-private deal with Leonard Green & Partners that implied a total enterprise value of $3.1 billion. That is not a mom-and-pop side hustle. That is the financial market looking at soap, water, and pavement and seeing a multi-billion-dollar platform. But there is an important catch. Adjusted EBITDA is not the same thing as money left in an owner's pocket. Mr.'s net income margin in 2025 was 9.8% after interest, taxes, depreciation, and other costs. A large chain has scale, systems, purchasing power, and corporate accounting. A single site owner has one road, one tunnel, one loan, and one local market. The public company numbers prove the model can be powerful. They do not prove every car wash is a gold mine. And the membership model has its own trap. A subscription customer is both the best customer and the most dangerous customer. They are the best customer because they pay automatically. They are dangerous because they can use the service repeatedly. A software company can sell one more login with almost no extra cost. A car wash cannot sell one more wash with no cost. Every visit uses water, chemicals, electricity, equipment life, vacuum time, and tunnel capacity. The perfect member is not the person who washes every day. The perfect member is the person who likes knowing they could wash every day, but actually washes just often enough to feel happy paying for it. That is a delicate psychological business. You want the customer to feel like the membership is a deal, but if too many members use it constantly, costs rise, lines get longer, peak hours jam up, and the membership becomes less convenient. Nobody wants an unlimited pass to a traffic jam. And like every subscription business, car washes have churn. People cancel, credit cards expire, customers move, they sell a car, they decide they are not using the plan enough. They get annoyed by a long wait. A competitor opens nearby with 3 months at a discount. Rinsed, using aggregated data from more than 3,000 locations, reported total monthly churn of 7.3% in the first quarter of 2026. That means a site with 1,000 members could lose around 73 members in a month before it has grown at all. This is the treadmill under the membership model. The revenue looks stable from a distance, but every month the operator has to replace the people who quietly leave. That is why the employee at the pay station matters so much. They are not just selling one wash, they are feeding the subscription engine. The free vacuums matter for the same reason. From the outside, free vacuums look like a giveaway. Why build a whole row of vacuum stations? Buy the motors, pay the electricity, maintain the hoses, and let customers use them for free. Because the vacuum is part of the funnel. It gives the customer a reason to stay on the property. It makes the wash feel more valuable. It turns a 3-minute exterior wash into a 10-minute car cleaning ritual. It helps justify the membership, and it creates a visible signal that the place is active. The vacuum may not be the product. It is the proof. Once you understand that, the layout of a modern car wash starts to make sense. The sign interrupts traffic. The pay lanes convert customers. The gate rewards members. The tunnel handles throughput. The vacuums improve retention. The whole site is designed to turn local drivers into recurring monthly payments. So far, the business sounds excellent. And in the right location, with disciplined spending, it can be.
But the same model that made car washes attractive also made them crowded. The industry was fragmented. Many older washes were independent or family-owned. The labor requirement was lower than many service businesses. Memberships made revenue more predictable. Older locations could be acquired, rebranded, upgraded, and pushed harder into subscriptions. To private equity, that looks like a roll-up. Buy or build lots of sites, centralize marketing, standardize operations, negotiate better chemical and equipment pricing, improve technology, sell more memberships, then sell the larger platform later at a higher valuation. That is how a roadside wash becomes a capital market story. But roll-ups have a habit of making everyone else notice the opportunity. One express wash opens on a busy road and does well. Another developer sees the line and builds 2 miles away. A regional chain enters. A franchise operator opens near the grocery store. Everyone starts offering cheap introductory memberships. The first wash proved demand existed. The next 5 washes divided. This is the key mental flip. A busy tunnel is not the same thing as a healthy business.
The line of cars tells you people want clean cars. It does not tell you how much debt is attached to the site. It does not tell you how many members are paying promotional prices. It does not tell you how many cancel each month. It does not tell you whether the owner paid too much for the land. It does not tell you if a competitor just got zoning approval down the street. Traffic is not profit. Membership count is not membership quality. And revenue is not cash flow. This is why real estate structure matters so much. Some operators own the land. Some lease it. Some build on ground leases. Some sell the real estate to an investor and lease it back to raise cash. Some leases are triple net, which means the tenant is responsible not just for rent, but also property taxes, insurance, and maintenance. Some leases have escalators that push rent higher over time. Some rent obligations keep going even if a location closes. That detail is invisible from the street. To a customer, a closed car wash is just a dark tunnel. To an owner, it may still be a monthly rent bill. Now add the operating risks that do not show up in the fantasy.
Cars can be damaged. Mirrors break, antennas snap. A driver can brake in the tunnel and cause a chain reaction. Someone can slip near the vacuums. A customer can dispute a recurring charge. A credit card can fail. A state can tighten auto-renewal rules. A city can complain about noise, traffic, water, or land use. Insurance can rise because the business combines vehicles, machinery, wet pavement, employees, and customers in one small area. None of these risks means the business is bad. They mean the business is real. And cities are starting to treat it that way. Across parts of the country, local officials have pushed back against new car wash development. Some worry about water use. Some worry about traffic stacking onto roads. Some worry about vacuum noise and dryers. Some simply look at another automated wash and ask whether that is the best use of a valuable corner. From the operator's perspective, the answer is obvious. A car wash can produce strong revenue on a relatively small site with fewer employees than many alternatives. From the city's perspective, that is not always a compliment. This is the tension at the center of the industry. The features investors like, automation, recurring revenue, low labor, and small footprints, are sometimes the same features that make communities resist more development. And then there is weather.
Rain can kill demand because people do not want to wash a car that is about to get dirty again. But rain can create demand if it leaves cars muddy afterward. Snow can be great because road salt makes people desperate to wash. But snow can also freeze equipment, close roads, and keep customers home. A dusty summer can be excellent in one region and a water restriction problem in another. The car wash owner watches the sky like a farmer, except the field is a parking lot full of sedans. Now come back to Zips. In early 2025, Zips entered Chapter 11 with about 260 locations across 23 states and proposed cutting roughly $279 million of debt. It later emerged from the restructuring and said it had strengthened its financial foundation, reduced debt obligations, and optimized its real estate portfolio. That story is not proof that car washes do not work. It is proof that car washes can work operationally while failing financially.
The tunnel can keep spinning. The customers can keep coming. The membership program can keep charging. And still, the mix of debt, leases, growth expectations, competition, labor, repairs, labor market reality can force the company to restructure. That is the warning label on the whole industry. The car wash does not fail because people stop wanting clean cars. It fails because the margin between the money coming in and the obligations going out was thinner than the owner thought.
To see the good version and the bad version, imagine two car washes that look almost identical from the road. The first sits on a strong corner near dense housing, grocery traffic, and commuters. The entrance is easy. The tunnel is reliable. The owner did not overpay for the land. The loan is manageable. The team sells memberships without giving away the store. The vacuums work. The experience is fast. The market is not oversaturated. In that version, the business can be excellent. Retail washes bring in high-margin walk-in revenue. Premium packages lift the average ticket. Memberships create a stable monthly base. The cost of serving one more car is low enough that volume matters. The customer comes back because the location is convenient, the car looks good, and the process is almost frictionless. That is the dream. Now take the same building and change a few details. The land cost more than expected. Construction ran over budget. The site opened 6 months late. Interest rates rose. The operator launched with aggressive discounts to build the member count. A competitor opened nearby with a cheaper promotion. Churn increased. Retail traffic softened. A pump failed on a busy weekend. The city increased sewer fees. Reviews started complaining about long lines and wet cars. Nothing dramatic happened. There was no single explosion. The business just started leaking.
A little more debt than planned, a little less revenue than expected, a little higher churn, a few more repairs, a few more rainy weekends, a few more customers deciding the wash down the street is good enough. That is how the easy money version disappears. For a large chain, scale can help. They can buy better, advertise better, use better software, test pricing across markets, and spread corporate costs over hundreds of sites. But scale can also hide mistakes until they are very expensive. More sites can mean more leases, more debt, more integration problems, and more chances to build too close to yourself. For a single site owner, the risk is more personal. You do not have 500 locations to smooth out one bad corner. You have one tunnel, one road, one local market, one loan, and one chance to make the habit stick. This is why buying an existing wash is not automatically safer than building one. An existing wash has history. You can see revenue, memberships, repairs, reviews, traffic, and seasonality. But you also inherit whatever the last owner did not fix. Old equipment, weak branding, tired vacuums, bad reviews, deferred maintenance, rent escalators, and a customer list built on discounts. And if the seller shows you a beautiful membership count, the first question is not just how many members. It is what kind of members.
How many pay full price? How many join during promotions? How many cancel each month? How often do they wash? How many cards fail? How many are heavy users who crowd the tunnel? How many joined because of a deal that is about to expire? Two washes can both claim 3,000 members. One has loyal, full-price customers. The other has bargain hunters waiting to cancel. The number on the dashboard is the same. The business underneath is not. So, does owning a car wash actually work? Yes, but not in the passive way people imagine. In the optimistic version, you own a well-located express tunnel in a market with enough drivers, enough disposable income, enough weather-related demand, and not too much competition. Your build cost is controlled, your financing is reasonable, your equipment is reliable, your membership base grows steadily, churn is manageable, retail traffic still shows up, and you maintain the site before small problems become expensive problems. In that world, the economics can be beautiful. The fixed asset is expensive, but once it is running, each additional profitable car helps absorb the fixed cost.
Membership revenue gives the business a base. Premium packages create upside. Free vacuums keep customers attached. The location becomes part of local routine. In the bad version, you still have a beautiful car wash. That is what makes it dangerous.
The sign is bright. The tunnel works most days. The vacuums are lined up neatly. Customers still come through. But the debt is too heavy. The market is too crowded. Churn is too high. Promotions trained customers to expect discounts. And the equipment keeps asking for money. The business is not empty. It is just not profitable enough to justify what it cost. A car wash looks like a machine that turns dirty cars into money. But from the inside, it is a machine that turns traffic, water, chemicals, electricity, labor, maintenance, software, debt, real estate, and customer psychology into cash flow. If those pieces line up, it can be one of the best local service businesses in town. If they do not, the same tunnel that was supposed to print money can become a very expensive way to spray water at cars. So if you ever think about owning a car wash, remember this. You are not really buying soap. You are not really buying brushes. You are not even just buying a building. You are buying a habit. You are betting that enough people in one specific neighborhood driving one specific road will pay you every month for the feeling that a clean car is always 3 minutes away. And that can be a great bet, but only if the problems do not recur faster than the payments do.